What's up guys, welcome to door number 11 of the finance calendar, where we dive into 24 financial ratios in 24 days. Don't forget to subscribe so you don't miss any of the ratios, and let's go! Today we are going to talk about the current ratio, which tells us how well a company is able to pay its short-term obligations. Short-term means those obligations that are due within a year. Current ratio is calculated by dividing the current assets by current liabilities. Let's take a look at an example. You can find all the required information from the company's balance sheet. For example, Intel's current assets are $61.3 billion and the current liabilities are $29.57 billion. This means that the current ratio is 2.07. So what does this tell us about Intel? When the company has a current ratio of less than 1, it means that they don't have the capital to pay the short-term obligations if they were all due at once. If the current ratio is over 1, it means that the company is able to pay the short-term obligations even if they were all due at once. Since Intel's current ratio is 2, it means that they could pay twice the amount of short-term obligations. So what is a good current ratio? This again depends on the industry, and the higher isn't always the better. A high current ratio could mean that the company is not using its resources efficiently because they are keeping excess cash instead of investing it. Different industries have different current ratios, so you should compare the company's current ratio to the industry average. As always, use all the available information and ratios when making investment decisions. That's it for today's financial ratio. Hit the like button if you found this video helpful and subscribe so you don't miss the future ratios. Have a great day and I'll see you tomorrow. Bye!